Hey traders, and welcome to the 6th video in this trading course where we will be covering Japanese candlestick patterns. This will include 4 different chapters, those being the introduction to Japanese candlesticks, bullish and bearish candlesticks, reversal and continuation patterns, and lastly doji and spinning top patterns. So let's dive straight into the introduction to Japanese candlesticks. Japanese candlesticks are a type of chart used in technical analysis to represent the price movement of an asset. The candlesticks are composed of a body and 2 wicks, and they provide information about the open, high, low, and close prices for a given period of time. Each candlestick represents a single period of time, such as a day or an hour, and can be used to identify patterns and trends in a securities price action. Candlestick charts are popular among traders because they provide more visual information than traditional bar charts, making it easier to identify trends and potential reversal points. The body of a candlestick represents the difference between the open and close prices for a given period. If the close price is higher than the open price, the candlestick is typically colored green or white and the body represents buying pressure. If the close price is lower than the open price, the candlestick is typically colored red or black and the body represents selling pressure. The wicks or shadows of a candlestick represent the high and low prices for a given period. The upper wick represents the high price and the lower wick represents the low price. If a candlestick has a long upper wick and a short lower wick, it suggests that buyers push the price higher during the period, but sellers ultimately won out and push the price back down. Conversely, if a candlestick has a long lower wick and a short upper wick, it suggests that sellers push the price lower during the period, but buyers ultimately won out and push the price back up. Japanese candlesticks can be used in conjunction with other technical analysis tools such as trend lines and moving averages to identify potential trade setups and confirm trend signals. In conclusion, Japanese candlesticks are a popular type of chart used in technical analysis to represent the price movement of an asset. By understanding how to read and interpret candlesticks, traders can gain valuable insights into an asset's price action and make more informed trading decisions. Next up, bullish and bearish candlesticks. In Japanese candlestick charts, bullish candlesticks are those that indicate a price increase or buying pressure in the market, while bearish candlesticks are those that indicate a price decrease or a selling pressure. Let's take a look at some examples of bullish and bearish candlesticks. A bullish candlestick is one where the close price is higher than the open price. This means that buyers are in control and there is a higher demand for the asset. An example of a bullish candlestick is the hammer candlestick, which has a small body and a long lower wick. The hammer candlestick indicates that buyers were able to push the price up from its low, and it is a potential signal that a reversal is about to occur. On the other hand, a bearish candlestick is one where the close price is lower than the open price. This means that sellers are in control and there is a higher supply of an asset. An example of a bearish candlestick is the engulfing candlestick, which has a large body that completely engulfs the previous candlestick. The engulfing candlestick indicates a strong selling pressure and a potential signal that a trend reversal is about to occur. It's important to note that candlestick patterns should not be relied on in isolation and should always be considered in the context of the overall market and other technical analysis tools. In conclusion, understanding bullish and bearish candlesticks is an important aspect of technical analysis. By identifying these patterns, traders can gain insights into the market sentiments and make more informed trading decisions. Next up, reversal and continuation patterns. Reversal patterns are chart patterns that indicate a potential trend reversal, where the current trend is likely to change direction. Continuation patterns, on the other hand, indicate that the current trend is likely to continue. Let's take a closer look at some common reversal and continuation patterns. Reversal patterns. Head and shoulders. This is a pattern that indicates a potential trend reversal from bullish to bearish. It consists of 3 peaks, with the middle peak being the highest, forming a head, with 2 smaller peaks forming shoulders on either side. Double top bottom. This pattern occurs when the price reaches a high or low twice but fails to break through, indicating a potential trend reversal. Bearish, bullish, engulfing. These patterns occur when a small candlestick is followed by a larger candlestick that completely engulfs the previous one, indicating a shift in momentum. Continuation patterns. Flag and pennant. These patterns are formed when the price experiences a brief consolidation period before continuing in the direction of the previous trend. Ascending, descending triangle. These patterns occur when the price creates higher lows and a resistance level, or lower highs and a support level, indicating a potential continuation of the current trend. Symmetrical triangle. This pattern is formed when the price creates a series of higher lows and lower highs, indicating a period of indecision before the continuation of the current trend. It's important to note that these patterns should not be relied on in isolation and should always be considered in the context of the overall market and other technical analysis tools. In conclusion, understanding reversal and continuation patterns is an important aspect of technical analysis. By identifying these patterns, traders can gain valuable insights into the market sentiments and make more informed trading decisions. And lastly, Doji and spinning top patterns. Doji and spinning top patterns are candlestick patterns that can provide traders with insights into market sentiment and potential changes in trend direction. A doji is a candlestick pattern that forms when the opening and closing prices are very close, creating a small or non-existent body. This pattern indicates indecision in the market and a potential reversal or continuation of the trend. There are four main types of doji patterns. Long-legged doji. This pattern occurs when the opening and closing prices are the same, but there is a long upper and lower shadows, indicating significant volatility. Dragonfly doji. This pattern occurs when the opening and closing prices are at the high of the day with a long lower shadow, indicating a potential bullish reversal. Gravestone doji. This pattern occurs when the opening and closing prices are at the low of the day with a long upper shadow, indicating a potential bearish reversal. Four price doji. This pattern occurs when the opening, closing, high and low prices are the same, indicating a period of consolidation and potential reversal. A spinning top is a candlestick pattern that forms when the opening and closing prices are close, but the range between the high and low is relatively large. This pattern indicates indecision in the market and a potential reversal or continuation of the trend. There are two main types of spinning top patterns. Bullish spinning top. This pattern occurs when the opening and closing prices are close to each other but higher than the low of the day, indicating potential bullish sentiment. Bearish spinning top. This pattern occurs when the opening and closing prices are close to each other but lower than the high of the day, indicating potential bearish sentiment. In conclusion, understanding doji and spinning top patterns can provide traders with valuable insights into market sentiment and potential changes in trend direction. However, it is important to consider these patterns in conjunction with other technical analysis tools and in the context of the overall market. That is it for this video on the ever so popular Japanese candlestick patterns, guys. By understanding these candlesticks, you'll be well on your way to a more profitable trading journey. See you in our 7th video where we will be covering Fibonacci retracements and extensions.